There is a signature on a piece of paper, possibly from 40 years ago. That signature made you personally responsible for every dollar of tax your husband or wife ever owed. Not half of it, all of it. It does not matter that you never saw the money. It does not matter whose income it was, whose account it went into, who spent it. You signed. That was enough. That is one of 5 things about tax debt in this country that almost nobody understands. I am going to give you all 5 today. Now, here is why I want you to stay even if none of this is your situation. Because the framing on this subject is almost always wrong, and it costs people enormously. Nearly every video about tax debt is about arguing that you do not owe it. That is not this video. Everything I am about to tell you assumes the debt is completely real, correctly calculated, legitimately yours. And here is what almost nobody tells you. Even when the debt is entirely real, there are at least 5 separate ways it can be reduced. Frozen, transferred off you, made to expire permanently, not by fighting it, by using provisions that Congress and the agency itself built deliberately, wrote down, and published. So this is not a video about escaping something. It is a video about the difference between a person who owes a tax debt and knows the rules, and a person who owes the same debt and does not. Those 2 people end up in wildly different places, and the debt is identical. 5 things. 1. Why a joint signature makes you a full target, and the relief written specifically for spouses who were kept in the dark. 2. The expiration date on tax debt. Real. Most people have never heard of it. The agency does not advertise it. 3. What happens when you genuinely cannot pay anything at all? A formal status, not a plea. 4. How penalties come off, and why the fastest route has nothing to do with hardship. 5. Settling for less than the full amount, and the honest truth about who actually qualifies. Now, I want to say the most important sentence in this video right at the start. Doing nothing is the single most expensive choice available to you. Everything in this video requires you to raise your hand. Not one of these happens on its own. My name is Kevin. I read the rules so you do not have to. Every week I go looking for the thing that quietly decides what happens to your money, and I bring it here before it costs you anything. If that sounds useful, subscribe and turn on the bell, because the second thing on this list runs on a clock that can be accidentally extended by doing the wrong thing. And once you have extended it, you cannot take it back. Let me start with the signature. When 2 people file a joint tax return, they are not splitting the responsibility down the middle. They are not splitting it according to who earned what. In law, it is called joint and several liability. What it means in plain English is that the agency can collect the entire bill from either one of you individually. So, think about how that actually plays out. One spouse runs a business. One spouse handles the money. That spouse decides, for whatever reason, not to pay the tax that was owed. Years pass, and then that spouse dies, or leaves, or the marriage ends. The file does not close. The agency simply turns to whoever is still standing, and the person still standing is frequently somebody who never saw a bank statement, never had access to the business accounts, signed a return every April because it was handed to them across a kitchen table with a pen. Their wages get garnished, their refund gets taken, their bank account gets levied, for a bill created entirely by somebody else's income and somebody else's decisions. I want to be precise about something here, because this is the part that catches widows hardest. Death does not end this. If your husband owed tax on a joint return, that debt does not die with him. It sits with you, in full. And a great many people discover it in the weeks after a funeral, at the worst possible moment of their entire lives. There is a second version of this that catches divorced people just as badly. Let me name it clearly. A divorce decree that says your former spouse is responsible for the tax debt does not bind the tax authorities. Not even slightly. That agreement is between the 2 of you and a state court. The federal government was not a party to it. It is not bound by it. So a woman who divorced in 2009, whose decree plainly states that her ex-husband is responsible for every dollar of the tax owed, can still have her wages garnished for it. Her remedy against him is to go back to a state court and sue him for breaching the agreement, which is a completely separate and often futile exercise. Meanwhile, the collection against her continues. People find that genuinely hard to believe, and I understand why. It sounds like the agreement should count for something. It does not. Knowing that changes what you do about it. Now, the good news. And it is genuinely good. Congress saw this exact unfairness coming and built a way out. It is called innocent spouse relief. There are 3 different versions of it for 3 different situations. The first two apply when there was something actually wrong on the return. Income left off, a deduction that should not have been taken. That is called an understatement, and there are specific routes for it. But the situation I have just described usually is not a wrong return at all. The return was correct, the income was reported, the tax was calculated properly, it simply never got paid. That is an underpayment. The route for that is equitable relief. Let me tell you about Ruthanne. Ruthanne is 74. Her husband ran a small contracting business for 31 years, and he handled every single thing to do with money, not out of malice. That is simply how their marriage worked, the way it worked for a great many couples of that generation. Every spring he brought home a stack of papers and she signed where he pointed. She never once read a return. She would not have known what she was looking at if she had. He died 3 years ago. 4 months after the funeral, a letter arrived saying that $81,000 of tax was owed across 6 years and that she was responsible for it. She did not know the business had stopped paying. She did not have access to the accounts. She had no idea there was anything wrong at all until a letter told her there was. And her first instinct, which is the instinct almost everybody has, was to assume there was nothing to be done. That she had signed, and signing is signing, and that was the end of it. That is the whole reason the quiet rules exists. Plain English, printed large enough to read without hunting for your glasses, on the things that quietly decide what happens to your money, what relief actually exists, which form starts it, and the exact evidence that wins it, so that nobody assumes a letter is the final word when the law says it is not. It is at kevinexplains.shop. The link is in the description below and in the pinned comment at the top. And if you are watching this on a television right now, there is a code on the screen you can point your phone camera at. 7-day guarantee, always. If it does not hand you something you did not have before, you send it back. So here is a question worth sitting with. Have you ever actually read a tax return before signing it? Now, how innocent spouse relief actually works. This is where people either win or give up too early. The form is Form 8857. It is free to file. There are threshold requirements. You filed jointly. You are filing your request on time. There was no fraud and no shuffling of assets between the two of you. And the liability is genuinely attributable to your spouse rather than to you. Clear those, and there is a fast lane. The agency calls it streamlined relief. You qualify if 3 things are true. 1. You are no longer married, divorced, widowed, or legally separated. 2. Paying this would cause you genuine economic hardship. That broadly means your income sits below a threshold tied to the federal poverty guidelines, or your basic living expenses consume essentially everything you bring in. 3. At the time those returns were filed, you did not know, and had no reason to know, that the tax would not be paid. Hit all 3, and relief is supposed to be granted. Now, if you do not fit cleanly into that fast lane, you are not finished. You can still win on the full facts. The agency weighs a list of factors: your marital status, economic hardship, whether you knew, who was legally obligated to pay, whether you significantly benefited from the unpaid money, whether you have stayed compliant since, your physical and mental health at the time. Most of those are straightforward. The one almost everybody gets wrong is knowledge. People assume that because they signed, the agency will say, "You knew," or "should have known," and that is the end of it. That is not how it works. This is the single most valuable thing in this section. The agency's own published guidance says that when the other spouse controlled the finances, restricted your access to information, kept money in accounts you could not see, or handed you a return and told you to sign without explaining it, that control flips the knowledge factor in your favor, even where it would otherwise have counted against you. And the same thing happens to the benefit argument. The agency will often point at your life rather than your return. You lived in a good house. You took holidays. You drove a decent car. So the argument becomes that you obviously benefited, therefore you must have known. Under that same guidance, that argument collapses when the other spouse controlled the household and business finances. A comfortable lifestyle becomes neutral rather than damaging. It stops counting against you. So what you actually build is a record. Documentation showing the separate accounts. Evidence you had no access. The pattern of being handed a return and told to sign. Real numbers demonstrating hardship. Proof the liability belongs to your spouse rather than to you. And one thing that sinks more of these claims than anything else: you have to stay compliant going forward. Nothing ends an innocent spouse case faster than the agency pulling your file and seeing that you stopped filing or stopped paying after this started. Now, The second thing, and this one applies to absolutely everybody with a tax debt, regardless of marital status. Tax debt expires. I want to say that again, because most people have genuinely never heard it. Federal tax debt has an expiration date, written into law. Generally, the agency has 10 years from the date the tax was assessed to collect it. After that, the debt legally ceases to exist, not reduced, gone. It is called the collection statute expiration date. It is one of the most consequential facts in this entire subject, and almost nothing the agency sends you will mention it. So somebody who has been carrying a debt from 8 years ago is in a very different position from somebody who was assessed last year. The correct strategy for those two people is not remotely the same. Now here's the part that requires real care, and it is why I put a warning in the opening of this video. That 10-year clock can be paused. Several things stop it and add the pause time onto the end. Filing bankruptcy pauses it. Being outside the country for 6 months or more pauses it. Having an offer in compromise under consideration pauses it. Plus 30 days afterward. Requesting a collection due process hearing pauses it. A pending innocent spouse request pauses it as well. Which means, and this is genuinely uncomfortable, some of the relief options in this very video will extend your clock while they are pending. That is not a reason to avoid them. For most people, an approved offer or a granted innocent spouse claim is worth far more than the months added. But it is a reason to know where you stand on that clock before you file anything. The right move for somebody with 9 years elapsed is frequently different from the right move for somebody with 2. And you can find out. You are entitled to request your account transcript, which shows the assessment dates. That is the starting point for the arithmetic. And it costs nothing. Let me be practical about how you actually get that. Because it is simpler than people expect, and it is the single most useful thing anybody watching this can do today. You want what is called an account transcript for each year in question, not a return transcript which just shows what you filed. The account transcript shows the activity on the account, including the date the tax was assessed. That is the date the clock started. You can request it through your own online account with the agency, or by telephone, or by posting in a form. It is free in every case. When it arrives, the line you are looking for shows an assessment, with a date beside it. 10 years from that date is your starting figure, before accounting for anything that paused it. And if the transcript is difficult to read, and they genuinely are not written for ordinary people, that is exactly the kind of thing a free taxpayer clinic will walk through with you in 20 minutes. Now, before I move on, there is a distinction here that confuses an enormous number of people and costs some of them real money. Let me draw it clearly. Innocent spouse relief, which I have just described, is about a tax debt that you should not be held responsible for. There is a completely separate thing called injured spouse relief. Despite the similar name, it addresses an entirely different problem. That one is for when you file jointly, you are owed a refund, and the government seizes the whole refund to pay a debt that belongs only to your spouse, their student loan, their child support, their older tax debt. In that situation, you are not disputing responsibility for anything. You are saying that part of that refund was mine, from my income and my withholding, and it should not have been taken for somebody else's debt. There is a form for it, and it can be filed alongside your return or afterward. So the shorthand is this. Innocent spouse means I should not owe this. Injured spouse means that refund was partly mine. People routinely file the wrong one, and the wrong one gets rejected, regardless of how strong the underlying situation was. Let me tell you about Bertram. Bertram is 69. He is owed roughly $26,000 since a business failed in a year he would rather not talk about. He has never filed anything, never requested anything, never spoken to anybody about it. He has simply lived with it, quietly, for a long time, the way people do with things that frighten them. And the thing Bertram does not know is that he is inside the last 2 years of his 10-year window on most of that balance. He has spent nearly a decade in a low-level state of dread over something that is, on the current trajectory, going to expire on its own. Now, I want to be careful here because I am not telling anybody to hide from a tax debt and wait it out. That is not advice, and it is not what I am saying. The agency has real collection powers, and it uses them. And a debt in its final years is exactly when collection activity tends to intensify. What I am saying is that Bertram made a decision 10 years ago to know nothing, and that decision meant he could not tell the difference between a situation that was genuinely dangerous and one that was nearly over. He carried the same fear either way. That is exactly the gap this guide closes. Not to make anybody a tax professional, to put the handful of facts that tell you where you actually stand in one place, in plain language, so that a person is never afraid of the wrong thing for a decade. Same place, Kevin Explains .shop. Link in the description and in the pinned comment at the top, and the code on your screen if you are watching this on the television. 7-day guarantee, no argument. Now, the third thing. What happens when you genuinely cannot pay anything at all? There is a formal status for this. It is called currently not collectible. Here is what it means. If paying anything toward the debt would leave you unable to cover basic living expenses, the agency can determine that you cannot pay, and it stops active collection. No levy on your bank account. No garnishment. Collection simply pauses until your situation improves. This is enormously relevant to people on a fixed income, and a great many of them have no idea it exists. They assume the only options are pay it or be pursued. There is a third door. How you get it? You ask and you prove it. The agency will generally want a collection information statement, which is Form 433F for most individuals, or Form 433A. You show your income, your expenses, and your assets, with documentation. The agency compares your figures against published standards for housing, food, transport, and medical costs. If your necessary expenses consume your income, you qualify. Now, 3 honest things about it, because I will not sell you half a rule. First, the debt does not disappear. It sits there. Interest and penalties continue to accrue on the balance while you are in this status. Second, the agency reviews it. This is not permanent. If your income improves, they can revisit and start collecting again. Third, and this is the piece that connects it to everything else in this video, the 10-year clock keeps running the entire time you are in this status. It does not pause for currently not collectible. Put those 2 facts together, and you have one of the genuinely powerful positions available in this entire subject. Somebody with a modest fixed income and a debt that is 7 years old can potentially be placed in this status, protected from collection, while the remaining 3 years of the clock run out on their own. That is not a trick. It is the plain interaction of 2 published rules. It is the reason knowing about the clock matters so much. 2 more practical things about this status that people ask about constantly. The first is what happens to a federal tax lien. Being placed in currently not collectible does not automatically remove a lien if one has already been filed. A lien is a claim against your property, and it can remain in place. So somebody in this status is protected from active collection, from levies and garnishment, and may still have a lien sitting on record. If a lien is causing you a specific problem, that is a separate conversation with its own routes, and it is worth raising by name rather than assuming the status handles everything. The second is Social Security. A great many of you are wondering whether your benefit can be taken for a tax debt. The honest answer is that it can be, through a program that can take a percentage of a monthly payment. But hardship matters enormously here, and this status is precisely the argument against it. If your benefit is what keeps you housed and fed, that is exactly the case you are making when you file the financial statement, which is why doing nothing is so expensive in this particular situation. The person who never files the paperwork has never made the argument, and an argument that was never made cannot be accepted. Now, the fourth thing. Penalties. An enormous share of what people owe is not tax at all. It is penalties, plus interest calculated on those penalties. Failure to file, failure to pay, both accumulating month after month. It is entirely ordinary for penalties to represent a substantial portion of a balance, and penalties come off far more easily than tax does. There are 2 routes. The first is the one almost nobody knows about, and it is the easier of the 2 by a wide margin. It is an administrative waiver, commonly called first-time abatement. It has nothing to do with hardship, nothing to do with your circumstances, nothing to do with having a good excuse. You qualify on 3 conditions. You had no significant penalties for the 3 tax years before the one in question. You have filed all currently required returns. You have paid, or arranged to pay, any tax due. That is it. Meet those 3, and the penalties for that year can be removed. You can request it by telephone. 1 call. The reason so few people get it is simply that the agency does not offer it. You have to ask by name. The second route is reasonable cause. This is for situations where something genuinely prevented compliance. Serious illness, a death in the immediate family, a natural disaster, records destroyed, incorrect advice from a tax professional you reasonably relied on. Reasonable cause requires you to explain, in writing, what happened, when it happened, and how it prevented you from meeting the obligation. Documentation helps enormously. Hospital records, a death certificate, correspondence with the professional who advised you. And here is the sequencing that saves people money, which almost nobody gets right. If you qualify for first-time abatement, and you also have a genuine reasonable cause argument, ask for reasonable cause first, because first-time abatement can only be used once in a stretch of years. If you spend it on a year where you had a legitimate reasonable cause argument anyway, you have wasted it. Save the automatic one for a year where you have no story to tell. Now, the fifth thing, settling for less than you owe. This is the one everybody has heard of, mostly through advertisements, and it is the one most badly misrepresented. It is called an offer in compromise. Here is what it genuinely is. The agency can accept less than the full balance when it concludes that the amount offered represents the most it can realistically expect to collect from you within the time it has left to collect. That last part is the whole thing, and it is why the 10-year clock keeps reappearing in this video. The calculation is fundamentally about what they can get before the clock runs out. How it works in practice. You file Form 656, along with a detailed financial statement, Form 433A for individuals. There is an application fee of $205 and an initial payment, typically 20% of your offer if you are paying in a lump sum. And here is the piece that matters most to this audience. Both the fee and the initial payment are waived entirely if you qualify as a low-income taxpayer, generally defined as income at or below 250% of the federal poverty guidelines. A great many people watching this qualify for that waiver and have no idea. The agency looks at three things: your income, your expenses, the equity in your assets. It values assets at roughly 80% of market value, on the theory of a quick sale minus what is secured against them. Now the honest parts. Review takes 6 to 24 months. Collection is generally suspended while it is pending, which is a real benefit. But the 10-year clock is also paused during that time, plus 30 days. You must stay completely compliant throughout. Filing, paying, everything. Falling out of compliance while an offer is pending is among the fastest ways to have it rejected. And most offers are rejected. That is the truth, and you should hear it from me rather than from an advertisement. The people who succeed are generally those with genuinely limited income, minimal asset equity, and a realistic offer. Which means for a great many retirees, an offer in compromise is not actually the best route. Currently not collectible status, combined with a clock that keeps running, frequently achieves a better outcome with less paperwork, less cost, and no pause on the expiration date. Let me tell you about Corinne. Corinne is 71. She owed about $19,000. She saw an advertisement on television promising to settle tax debt for pennies on the dollar. She telephoned. She paid $4,000 up front to a company that promised to handle everything. They filed an offer. It was rejected because her situation was never a good fit for one. The company kept her $4,000. What she actually qualified for, on the numbers she had all along, was currently not collectible status. It would have cost her nothing. It would have stopped collection just as effectively. It would not have paused her clock. She did not do anything foolish. She did what a frightened person does when somebody on television offers to make a frightening thing go away. Now, the warning, because this industry is full of people like the ones who took Corinne's money. Every genuine program in this video is free to apply for. Innocent spouse relief is free. Currently not collectible is free. Penalty abatement is free. The offer in compromise has a fee of $205, which is waived for lower incomes. And that fee goes to the government, not to a company. Nobody has special access. There is no insider route, no relationship, no expedited channel. A company charging you thousands is filling in the same free forms you can fill in. That does not mean professional help is never worth it. A genuinely complicated innocent spouse case, or a large offer, can absolutely justify hiring somebody qualified. But the qualified person is an attorney, a certified public accountant, or an enrolled agent, and they will tell you honestly whether you have a case before taking your money. And there is a completely free option almost nobody knows about. Low-income taxpayer clinics exist across the country specifically to represent people in disputes with the agency. They are free or nearly free. They are staffed by qualified professionals. They handle exactly these cases. Also, and this is important, the agency will not telephone you out of nowhere demanding immediate payment, threatening arrest, or asking for payment by card or gift card. Contact begins by post. If you get that call, put the phone down. Now, let me give you my honest opinion, which is only that. I do not think the collection system is unfair in its design. A country that cannot collect tax does not function. And every one of these relief provisions exists precisely because Congress recognized that rigid collection produces cruel outcomes. My objection is about who finds out. Every provision in this video is published. All of them are free. None of them are secret. And the agency does not proactively tell you about a single one. The letter that arrives tells you what you owe and how to pay. It does not say you may qualify for relief as a spouse who is kept in the dark. It does not say this debt expires in 3 years. It does not say there is a status for people who cannot pay anything. So the person who gets relief is not the person who most deserves it. It is the person who found out, which means it flows toward people with resources, education, and confident family members, and away from a 74-year-old widow who assumes a letter is the final word. And the same silence is exactly what companies like the one that took Corinne's money depend on. They are not selling access. They are selling the information itself, which was always free, to people nobody bothered to inform. All right, here is your list. 5 things. 1. If you signed joint returns and the debt came from your spouse's income and decisions, file Form 8857. Being widowed or divorced makes your case stronger, not weaker. 2. Request your account transcript and find out your assessment dates. You cannot make a sensible decision about any of this without knowing where you sit on the 10-year clock. 3. If paying anything would leave you unable to cover basic living costs, ask for currently not collectible status by name. It stops collection, and it does not pause your clock. 4. Ask for penalty abatement by name. Ask about first-time abatement. And if you also have a genuine reasonable cause story, use that one first and save the automatic waiver. 5. Before paying any company anything, telephone a low-income taxpayer clinic. They are free, and they will tell you honestly what you qualify for. And if your own situation is tangled, if you are holding a letter and cannot work out which of these fits you, write to me. The address is on your screen and in the description below, and I read every one that comes in. One last thing before you go. Ruthanne signed where her husband pointed every spring for 31 years. She found out 4 months after his funeral what those signatures meant. Bertram spent almost a decade afraid of something that was quietly running out of time the entire while, because he decided it was safer not to look. And Corinne paid $4,000 for something that was free, to a company that knew exactly what she qualified for and sold her something else. None of the 3 did anything a reasonable person would not have done. Not one of them was treated unfairly by any individual person. Every one of them was on the wrong side of a system where the relief is real, the relief is free, and nobody whose job it is to tell you about it actually exists. So go and find out where you stand this week, while there is still time to choose. Get the transcript, learn the dates, ask for things by name. Because in this system, the difference between the person who pays and the person who does not is almost never the size of the debt. It is whether anybody ever told them what was available. I am Kevin. Thanks for watching. Do not forget to check the quiet rules at kevinexplains.shop.